हरे कृष्णा। आप सभी का एक बार फिर से स्वागत है मेरे इस चैनल पर्पसफुल प्रॉस्पेरिटी के ऊपर। तो आइए आज वॉरेन बफेट का एक कोट पढ़ते हैं। ऑलवेज एसोसिएट योरसेल्फ विद पीपल हु आर बेटर देन यू, बिकॉज बेटर पीपल, इफ यू एसोसिएट विद बेटर पीपल, you get an opportunity to become a better version of yourself. Second thing Warren Buffett says is that you must read. So he's really putting very high stress on reading. At one place he's saying that when he was at age of 19, he get a chance to read the Intelligent Investor book, and he is saying that he, even at the age of 80 and 90, he is still getting the benefit of reading that book. So you're reading it once, but then the knowledge is going to remain with you for whole of your life. So that's why always read. So when he, looking at the Warren Buffett kind of investor, and when he's saying the importance of reading, so we thought as a channel, it would be good that we start a new series where we also read some of the great books recommended by great investors so that we can also associate with them and try to get the knowledge which they have gained over a long period of time, because we understand that they are more knowledgeable, they are a better person than us, so we can associate with them by reading their books. And today we are going to associate with Mr. John Bogle. And we are going to start the series. And the first book that we have picked up is The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market return. So, in today's class, we are going through the introduction of this book. And then over the coming few sessions, we are going to go through a couple of important chapters and the key learnings from this book. And we are going to share it with all of you. So the introduction, for the introduction and the reading for this book, we have taken the 10th edition. And the introduction begins with a statement says, don't allow a winner's game to become a loser's game. So we really have to important, it's really important to understand that what is a winner's game and what's a loser's game. Are you playing a winner's game or are you playing a loser's game? So in the introduction of this book, we understand few things, and few of them are that investing in equity for a long term has been a winner's game. And successful investing is all about common sense. Simple arithmetic suggests that, and history confirms that the winning strategy for investing in stock is through the low cost index fund, which is also known as passive investing. And academic studies also suggest that if you are a typical investor in individual stocks, with many of the newcomers are actually, then your returns have probably lagged the market by around 2% to 3% per year over a long period of time. And with the compounding, in our last session, we understand that even a 0.5% or a 0.1% for a very, very long time really makes a long difference. And here we are talking about 2 percentage points. So that's a very big number. And the last point in the introduction it says is that your chance of earning the fair share of market return are greatly enhanced if you minimize your trading in stocks. So it's always about long-term holding and buying some good businesses, buying the full market. Let's understand what is this index fund. So it has been explained that it's a fund that hold all market portfolio and hold it forever. So there are two important things. You are not just holding a selected stocks, you are holding the all market portfolio. So we can say the Nifty 50 or a Nifty 500 and hold it forever. We are not going to sell it. We are holding it forever and ever. And that's the way to become the wealth. And with index fund, the important thing is that you only have stock market risk. All other risk have been eliminated. So there are four kinds of risk. Apart from the stock market risk, you have three more kind of risk. One, you have individual stock risk. One, you have market sector risk. And one, you have the fund manager selection risk. We have seen that all the mutual fund ads and everybody is saying that please read the document carefully because this is having a stock market remains. because this having stock market risk. But then nobody is saying that apart from the stock market risk, you have three other type of risk also that nobody is informing to the common investor. But the John Bogle has really, in his introduction, clearly says that the index fund are the only way to get the stock market to remove all the three other risk of individual stock, market sector, and the fund managed selection. And the only risk remain is the stock market risk. So we are taking the least return, risk and taking the with the least risk, we are taking the maximum return. So the risk adjusted return in an index fund will be better than any other fund manager selected mutual fund, or even if we select our stocks individually. And this is designed to hold for a lifetime. The index fund is indeed the only investment that's essentially guaranteed that you will capture your fair share of return that business earns. Further, it's going in the introduction, few more key learnings that we have is that this book changes the very way you think about investing. I think that it's very important that we really understand that what is investing or what is gambling, what is speculation, what is trading. Unless we really understand about these things, in the beginning, everybody thinks himself as an investor. Everybody think that I'm going to become the next Warren Buffett, but that's not true. You really have to understand what this investing is all about. And this book really gives a completely different way to think about what is investing. It teaches you the long-term investing serves you far better than any short-term speculation. It further teaches you the value of diversification, which is very important. It tell you the powerful role of investment costs that we are going to occur. So we really need to make sure that we invest in a product which is a low cost, because when the cost is going to compound, it's going to really hurt our returns. And then further, it says about the one of the very important principle of reversion to mean in investing. I think whenever we do any sort of fund selection, we look for a 3 year, 5 year, 10 year performance, and whichever is performing the best, and we try to invest in that fund. And once you invest in that fund, within a 1 or 2 year, you really realize that your fund is not performing because you were chasing a fund performance, and and everybody will come, especially in the stock market, will come a reversion to mean. So this is a kind of a pendulum. It goes to an extreme end of left, it again goes to an extreme end of right, and then it again comes back to the main place in the middle. So we really make sure that we really understand that reversion to mean and don't rely on past performance. I think every mutual fund document says that don't rely on past performance, but nobody is trying to understand that why they are saying this thing. This statement was written just to understand the basic principle behind this is reversion to mean. And since nobody's understanding that thing, they are always saying that I am going to select the best performing performance fund. And then after every 2 years, they will post multiple queries to multiple channels, to multiple investor advisors or influencers that my fund is not performing. What should I do? So all that problem will be gone if you are investing in an index fund. And then the last, it's going to explain us how a financial market works. So financial market working is completely different than any other businesses. So it's really important that we understand the basics of a financial market. So that's also being the teaching of this book. Then the index fund is indeed the only investment that's essentially guaranteed that you will capture your fair share of returns that business earns. So an index fund investor is not trying to beat the market. That's not a winner's game. But an index fund investor is trying to get his fair share. If my my country is progressing with 6% and I'm having an inflation of 4%, then I would say my fair share is of 10%. That is 6 plus 4. So I want my 10% return to be given for all my investments. And if you want to achieve something like this, then I would say index fund is the only investment. He is not saying that it is one of the investment. It's saying it's the only investment. Then the introduction further explains about a zero sum game. And I think this is a very eye opening thing. We have to really understand that in a stock market, a profit of one person is actually a loss of other person. So if a one person is winning, there is someone who is going to lose. So for every percentage of extra return above the market that one of us earns, another of our fellow investor suffers a similar kind of losses or shortfall of precisely the same dimension. So if a one mutual fund is going to win, there is another mutual fund who is going to lose. In the beginning, you can say that okay, since the Indian market was very new, so all these mutual fund companies or some of the so-called very intelligent investor, they are trying to beat the normal retail investor, and they are eating up all their money. But as and when we are making progress and our markets are maturing, now if you see, the retail participation has been very less. Mostly we have FIIs, FPIs, we have mutual funds, we have PMSs. So if all of them who are having the maximum knowledge about the stock market, and I would say much more than any retail investor can have, then how is it that one can beat the market? So definitely, if one is the winner, there is a loser also, and you will not be able to realize that who is a winner and who is the loser. So uh, John Bogle clearly says that before the deduction of the cost of investing, beating the stock market is a zero sum game. So this zero sum is not only applying for trading, it also applies for investing too. That's very important. Second thing, it talks about a loser's game. So there he's saying that the deduction of the cost of investing, after deduction of the cost of investing, the beating the stock market is a loser's game. Now you really have to decide, do you want to play a winner's game or do you want to play a loser's game? And here we have two very good quotes, one by Warren Buffett, where he says that when trillions of dollars are managed by Wall Streeters charging high fees, it will usually the managers who reap outsized profit, not the clients. Nowadays, we see that every business house is entering into this mutual fund industry of AMC. And if you look at them, they are the one who are getting the maximum profit out of them. You can look at their profit growth. You yourself can feel that are their clients getting that thing, or are these managers getting all that money? And then John Bogle also says that owing the stock market over a long term is a winner's game, but attempting to beat the market is a loser's game. So we really get a very good clarification in the introduction itself that what's a winner's game and what's a loser's game. So a common man, a common retail investor, I urge him to always be part of winner's game by investing in an index fund, and never be part of a loser's game where you try to beat the market. So here I have taken a screenshot from screeners, and if you look at, so this is for one of the AMC. If you look at their net profit, you can realize that from 319 they have moved to 1587. And if you look at their compounded profit growth for last 10 years, it was 16%. Can you see that? And I'm sure none of their investor has earned that kind of a compounding. Look at their 5-year profit growth. So it's 15%, 60%. It's more than the index fund itself. So, and how they are getting all these? Because of the extra cost that each of the retail investors are paying to them. They might be making much less than the index fund, but then because of this extra cost which they are paying to some of these highly reputed AMCs, it's the AMCs who are winning the game. That's what the Warren Buffett is suggesting in the previous quote. Then John Bogle further says that fund investors are confident that they can easily select a superior fund manager, but they are wrong. See, very clearly he's saying, I think every one of us, after a little bit of reading, we think that I can beat the market. Any ABC guys can come and say that, okay, I can beat the market. There are many fund influencers which they are selling a lot of their courses, and they are saying that, okay, you join my course and in 1 week I will tell you how to beat the market. And here John Bogle, who's having such a long investing career, and he's saying that you cannot do that. It is not possible. For a short duration, it's possible. But when we talk about investing, it's always for a long duration. 20, 30, 40, 50 years. And in a long run, my friends, you cannot find a superior fund manager. It is not possible. The reversion to mean principle is going to come. A few years he can have a extra very high returns, but then there will be followed by a few more years where his returns are lagging much behind the index funds. And in no way you can select such a fund manager. And even fund managers also changes within a fund. So how will you save yourself from this kind of a mistake? So you cannot do that. And the only way to, if you want to avoid all these confusions, then go for a passive investing and buy the whole market, buy an low cost index fund. Then in the last, John Bogle further says that you will almost never find a fund manager who can repeatedly beat the market. It is better to invest in an index fund that promises a market return but with significantly lowered fees. So this passive investing is for a common man. आम आदमी के लिए है ये. That if you really want the returns of your stock market, a fair share of your return, then you should select a lower fees index fund and invest in them forever. And that's the way to make wealth, or that's the way to do investment. And that's the introduction which John Bogle is giving to us in his very nice book, A Little Book of Common Sense Investing. So let's just try to get this common sense, because Warren Buffett says that investing is all about common sense. And I think we are getting an association to be with John Bogle and his vast learning. So we can also become a better investing by associating with him by reading his book. So in the next coming weeks, we are going to read a few more chapters of this book and we are going to share the learnings with you. I hope you guys enjoy this thing. If you really like the kind of work that our channel is trying to do, so please subscribe to our channel and like, share, and subscribe to the channel Purposeful Prosperity. Thank you for your time. Hare Krishna.